Assalamualaikum and hello everyone. Welcome to my channel. In today's presentation, our intention is to prepare the financial statement for publication, and we intend to have comprehensive examples together with the adjusting journal entries and full workings. The intention initially is to prepare you for the financial statement question in the final exam, which is question 1 for 30 marks, as well as to also prepare you for the submission of the group project 2 that is going to take up your 10% of the assessment. So let us start now. And I'm taking another question, which is previous semester group project with a company called Cellmix. Cellmix was incorporated in Malaysia that involved mainly in manufacturing and distribution of healthcare products within the Malaysian market. And below you have the trial balance for the year ended 31st of December year 6. So 31st of December year 6 is the current financial year, and that is also the current reporting date. So here you have the trial balance, and you can see that there were lists of balances, accounts balances on the debit and on the credit side. If you look at the requirement of the question, if you can go directly to the required section here, you are asked to prepare the following statements in a form suitable for publication and in compliance with the Companies Act 2016 and Malaysian Financial Reporting Standards. The applicable and approved Malaysian financial reporting standards. The one used in Malaysia is also of equal to those that were issued by the IASB, namely the IFRS and the IAS. You are asked to prepare the statement of profit or loss for the year ended 31st of December year 6. Statement of profit or loss here is also statement of profit or loss and other comprehensive income. So we're going to prepare the statement of profit or loss together with the other comprehensive income as part of the requirement of the question. For the year ended 31st December year 6, together with that, we're going to prepare the statement of changes in equity that will show the movement of share capital and reserves, the statement of financial position that will show the list of assets and liabilities and equity of the company. And finally, there will be notes to the financial statements that will show the movement of property, plant, and equipment, and also the movement on of the allowance for impairment of trade receivable in accordance with the requirement of MFRS 9, which is equivalent to IFRS 9. Movement on PPE will be in compliance with the requirement of MFRS 116. So make sure that you still remember those MFRS that you have learned much earlier. Okay, let's start. First, what we're going to do is we're going to look at the trial balance given. First is to classify. So when you classify them according to asset, liabilities, income, expenses, and equity, and be more specific by classifying into either current asset, current liabilities, non-current asset, and income, expenses. So I've done this classification for you, where you could see here, I've done the classification. If you can see what I've revealed here. Yeah, the non-current asset investment, so that should be in the statement of financial position. Of course, you need to take into consideration if there are any changes to the investment properties, freehold land. This is at cost. Remember, land is not depreciated. Building at cost, it is going to be depreciated, the non-current asset section here, except for investment property and investment, right? So investment and investment property are with different MFRS. And then you have the negative asset account, which is the contra asset account, the accumulated depreciation of building, plant and machinery, and motor vehicle that will later be deducted against the cost or the valuation figure of the non-current asset. Then you have your equity, the ordinary share capital. This one is showing the fair value of the shares as at the date here. And then you have the 7% redeemable preference shares. This is not an equity. This is a liability. More specifically, that is a non-current liability. So that shouldn't be included in the statement of changes in equity. Only equity and the reserve will be included. So you can see here, for example, EQ here stands for equity, but to be specific, these are the reserve, right? Same goes for the retained profit. This is also the reserve. What you need to take note is that the retained profit given here is as at 1st of January year 6. And the interim dividend that you have here is also an equity distribution using the profit for the year. And be careful, the interim dividend that is an equity is those related to the ordinary dividend. The interim dividend on the redeemable preference shares, this is not an equity distribution, but this is similar to debenture interest or interest expenses, which is a finance cost. So if you come across redeemable preference dividend, either final redeemable preference dividend or interim redeemable preference dividends, make sure you will include them in the finance costs. And that is, of course, for the redeemable preference shares. Other preference shares will be classified as an equity distribution. Then you have your investment income. Investment income will have its own separate line item in the statement of profit or loss, right? Investment income comprised of dividend and interest income. And then you have your current asset, trade receivable. This is the soft P item, current liabilities, trade payable. And you have the negative asset account, which is the current asset, negative current asset account here, allowance for impairment, which is the contra asset account for the trade receivable. Remember, trade receivable must be reported at the net realizable value. Then you have your cash at bank, your rent and other service revenue. This will be under other income. Because the nature of the business here is the manufacturing and distribution of healthcare, and this would just be classified as other income. And then you have your sales. Sales are your income, but to be specific, sales are your revenues, which is to be classified or accounted under MFRS 15. And then you have your cost of sales, which is expenses, the second line item in your SOPL. Your current asset, the inventory at cost here is the inventory as at 31st of December to year 6, which is the closing inventory. And you need to check if this is actual amount that you will report, because you need to go and check if there is any amount to be written down or any net realizable value of inventory which is lower than the costs. Then you have your admin expenses that has to be shown separately in the statement of profit or loss. Distribution expenses, go and check if there are any additional expenses for you to include. And then you have your expenses, interest paid on bank loan. You need to check whether or not this interest paid, is it has it been correctly provided for. So if you can see here, 20,000, and if you check the bank loan, it was 1.5 million. So if you just notice, 10% out of 1.5 million was 150,000. So therefore, you will need to check if there is any interest that you need to provide for. There are any things like accrued expenses, your tax paid, that has to be also adjusted to find out what is the tax expense. Okay, done. Now let us look at the additional information number 1. Additional information number 1 is on MFRS 102, inventory. On the right hand section that you have here, I have already provided some adjusting journal entries for each of the additional information. For example, item number 1, the net realizable value of the closing inventory is 350,000. Compare this with the cost of the inventory that was given in the trial balance. So if you can see here, the cost of the inventory here is 400,000, and if you compare with the NRV 350,000, the NRV is lower than the cost. So the difference of 50,000 you will have to write down. This is from MFRS 102, debit cost of sales that will appear in your SOPL. You need to go and add to your SOPL. Credit inventories, you need to go and adjust the 50,000, which is 400,000 minus 350,000. 50,000. So you have 50,000. That has to be credited to the inventories account. So that has to be adjusted in your SOFP later. Next, your sell mix. This is the reporting entity. Sell 200,000. That is the selling price of healthcare equipment, where the cost of the healthcare equipment was 150,000. It was sold off on 1st of December 2000 X8, right? 1st of December 2000 X8, which is supposedly the 1st of December 2000 X6 here. So let me just make a little correction here. To a local customer, Mimi Beauty, which is planning to expand its business around the city. Under the bill and hold agreement, if you can recall, bill and hold agreement is where the delivery of goods are being delayed at the request of the buyer for certain agreed reason. So here, if you can see here, Selmic asked Mimi to retain this healthcare equipment in its warehouse. So the reporting entity buy goods, but they do not want to take up the goods, right, to retain the healthcare equipment in its warehouse until the new premise that will place the health equipment is ready. So legal title and control are passed to the customer. So basically, Mimi Beauty will not have the goods yet. It will be retained by us. So it should be the other way around here. Mimi is the one that asks sell mix because Mimi is the buyer. Okay, we just make that correction here. Mimi Beauty asks Cellmix to retain this healthcare equipment in its warehouse until the new premise that will place the health equipment is ready. So we're not going to have it delivered to Cellmix, but it will be retained by us. However, the legal title and control are passed to the customer. Customer here is Mimi Beauty at the time the agreement is signed. So therefore, here there is a sale that need to be recognized, but none of this was recorded. So we have to record on behalf of Cellmix, because Cellmix is the reporting entity, to recognize the revenue from bill and wholesale to Mimi. You are going to debit trade receivable Mimi. If you can put the name of the customer for actual reference, to 200,000, that is the selling price, and you will credit revenue from sale of goods here, bill and hold 200,000. If you do that, your revenue will have increased by extra 200,000, and your trade receivable also will increase by 200,000. At the same time, you need to make adjustment to the closing inventory for the cost of goods sold under the bill and hold. If you refer here, 200,000 is the selling price, but the cost is 150,000. So what you need to do is you need to debit cost of sale 150,000 and credit the closing inventories 150,000. So therefore your cost of sale in the SOPL will have to be added, and the current asset inventories in your statement of financial position need to be reduced. Next is number 3. 31st of December, year 6, one of the company machine, which is a PPE that was acquired on 1st of January 2012. Okay, 1st of January 2012 is the date of acquisition of the machine. That is the date of acquisition, 1st of January 2012, and it was acquired at 150,000. That machine that was acquired in year 2012 here is actually year 2. I will make a little correction here. Year 2 at 150,000 was disposed of for 119,500. The disposal has not yet been recognized by Cellmix. So there was a derecognition or disposal of a machine, but that has not yet been recorded. So that is the journal entry that I have already prepared here. Derecognition of PPE, specifically the machine that was acquired on 1st of January, year 2. So to do that, you need to go and de-recognize the cost of the machine disposed. The cost of the machine disposed that was de-recognized should be on 31st of December. You will go and debit the disposal of machinery because machinery was disposed at cost 150,000. And this will later be shown in your notes to the PPE. So your notes to the PPE will show the de-recognition or disposal, which would be this 150,000. This 150,000 is the one that you will have to de-recognize, and that has to be reflected later in your notes to the PPE. Then you also need to remove the accumulated depreciation of the disposed machine prior to the disposal. So if you can check from year 2, 1st of January year 2 up till 31st of December year 6, that was 5 years. 5 years, right? So that was 5 years where I can put the working here. It is actually 1st of January year 2 and up till 31st of December year 6. For that 5 years period, the accumulated depreciation must be eliminated, to remove or to eliminate. So if you are used to the term eliminate, we can make use of that term here. It is the same. To eliminate, to write off, to remove is the same thing. Prior to disposal, meaning that from the date of acquisition until the disposal date. This is the disposal date, which is 31st of December 2000, year 6. Year 6. Year 6 is the date of disposal. So you remove that. How do you get the amount? 150,000 times 5% times 5 years. So that was the accumulated depreciation, 37,500. Now you need to recognize the proceed on the disposal of the machine. The proceed was 119,500. Debit bank for the proceed, 119,500. Credit disposal of machine, 119,500. When you debit your bank account, your current asset bank in the statement of financial position will have to be adjusted and need to be added with the proceed. The next task is for you to recognize the gain or loss on disposal. Here is the gain. Why? If you compare the selling price here, if you can check this green highlighter here, you have a selling price 119,000. You will deduct with your carrying amount of the asset on the day of disposal. How do you get the carrying amount? Take the cost minus the accumulated depreciation on the date of disposal. Remember, accumulated depreciation was 37,500, and 150 minus that, you will get the difference between selling price and the carrying amount to be 7,000. So that was a gain on disposal. Gain is part of other income. So debit disposal of machinery and credit the gain on disposal. You can also omit the disposal of machinery account by directly debiting it to the asset account, without debiting to the disposal account. That is also fine. This is just for revision purpose. Okay, then now you have the next item, which is number 4. Number 4 is on investment properties, where you are informed. If you can see the investment properties given in the question here, if you look at the investment property, okay, this is the investment property that you have here. It was 450,000. So this 450,000 is made up of, you are informed, a food court building that was acquired on 1st of January year 5 at 300,000. So that 450,000, 300,000 relates to a food court. And number 2, you are informed, it is also relating to a building that was acquired on 1st of July year 6 for an undetermined future use. If you talk about undetermined future use, you buy a property and you do not decide what to do with it, that is your investment property, because you are not sure with the future use, so that will be classified under investment property. So that 150,000 plus 300,000 was actually an investment property. The one in number 2 is still an investment property. Here the issue is the one in 4.1. Food court building that was acquired on 1st of January year 5 at 300,000. The food court has 20 shop units. However, those shop units cannot be sold off separately. So if you are to sell the shop units, you need to sell all 20 shop units. You cannot sell it like 10 of it or 5 of it or 2 of it. You need to sell the whole 20 shop units. Okay, so the 2 units were used as the company office. So if it's used as an office or maintenance room, that is functioning like a PPE. And you are also informed the remaining units, which refers to 20 minus 2, 18 units, were rented out to food hawkers. And they were ran being charges to the hawkers, and these were quite cheap. So meaning that the future economic benefits that you generate from the rental to the food hawkers were not that significant, which is equal to the average market rate, because it is the strategy of the company to attract hawkers and residents, as the location of the food court was isolated from the city center area. So in addition to that, part of the rental package, so when you rent out that 18 units of shop houses to the hawkers, the rental package also includes services such as high-speed Wi-Fi. You also give them satellite TV, maintenance and cleaning service. And if you read this, you would notice that these are under PPE function, where you are talking about providing service in the ordinary course of business. So if that is the case, it looks like this is not going to be an IP. This is a PPE. So even the 18 units, they are functioning like a PPE, since the rental expenses that were collected from the hawkers were just very cheap. If you can see this highlighter that I used red here, were quite cheap. So the total rental package plus service charged to the hawker was 1,500 monthly, and they have this breakdown. The breakdown was 500 for the rental, Wi-Fi service 450, maintenance 350, satellite TV 200, and the fact were only made known to the company's accountant at the end of year 6. Remember, year 6 is our reporting date. At the end of year 6, let's say 31st of December, year 6. As such, our accountant proposed for the reclassification of this property from IP, investment property, to a PPE. So IP is under MFRS 140 and PPE is under MFRS 116. So these 300,000 need to be reclassified, or in a simple word, you tend to say transfer, but this is not really a transfer, but it was a reclassification where you need to go and debit the PPE account. The building now become a PPE. So I'm going to show you here. So you're going to debit the property, plant and equipment here. The property, plant and equipment that you will debit is the building. Yeah, because now it functions as per the use as of PPE. So debit the property, plant and equipment account that we debit is the building. For how much? For the 300,000. And we need to go and credit the investment property. Which one? The building that was before this classified as an IP, and now that has to be reclassified as a PPE, and that was somewhere on 1st of January, year 5. And for that reason, you also need to do a little adjustment, because the depreciation has been undercharged. By right, starting from 1st of January, year 5 onwards until the current year and 31st of December, year 6, the building should have been accounted for as PPE. But only that the reclassification was being proposed to avoid non-compliance. So that was non-compliance, and now we want to comply with the correct MFRS. And what we need to do is we need to go and start providing the depreciation, but we cannot just provide the depreciation for the current year. We need to provide the depreciation from the day it was being reclassified. And here you need to go and provide the depreciation. 300,000 divided by 50 years starting from 1st of January, year 6. what you need to do is you cannot go and debit depreciation because that was happening on 1st of January year 5 until 31st of December year 5. What you can do is you cannot go and debit depreciation, but you can go and reduce the retained profit or the equity balance brought forward with the prior year depreciation that was undercharged. When I say prior year, I'm referring to 1st of January year 5 until 31st of December year 5. In that year, that was supposed to be a depreciation, but it was not being provided. Now we provide. So this is actually an error, and it is to be accounted under FAR 108. You go and adjust the prior period error, debit the equity balance brought forward. Here is the retained profit, 1st of January year 6. 6,000. How do you get 6,000? 300,000 divided by 50 years, which is the estimated useful life for the building, 50 years. So for 1 year, that was 6,000. And you need to go and adjust this in the statement of changes in equity by reducing the retained profit balance brought forward so that the retained profit balance brought forward is being restated. And then you will credit the accumulated depreciation that will appear in your notes to the PPE, specifically under accumulated depreciation section of the building. So that will be done later when we go to our notes on PPE. Number 7 is about depreciation. So you just need to provide the depreciation. So for the depreciation, I've done the calculation for depreciation in this workings here. So you can see there are the workings here. And let me just show you the depreciation for that. But before that, there was some figure that I've missed out, which is number 6, right? Number 6. We have straight away jumped to number 6 because of our building, but actually we are still at number 4. So let's go back to number 4. This is the building for future use. 4.2. So that was to be done for the depreciation. And then now we are looking at number 5. Number 5 is on MFRS 137. Where you have on 25th of November year 6, the Health Authority has announced the amendment to the current legal provision which requires all companies in Malaysia that involve in healthcare product to go through a quality certification program with immediate effect. So meaning that the outcome is probable, the outflow is probable. For the year ended 31st of December year 6, it was estimated that the cost to be incurred for such program is 24,000. So there should be a provision being made. And since this is a requirement of the health authority, a legal requirement, and that amendment has been made to the current legal provision, which requires all companies without miss, whoever in the healthcare product, to go through this certification program. So therefore, you need to provide a provision by the company. So company needs to provide provision. So when you provide provision, you will have to debit the profit or loss. Specifically, you can debit the operating expenses, or you can go and debit the certification cost, which is quality certification cost 24,000. And you can include them under admin expenses or under other operating expense, 24,000. Credit provision for certification costs, 24,000. And this is your current liability because you need to go and incur that almost immediately. So that is a current liability. Unless you can defer that for more than a year, that would be under your non-current liability. So number 6, number 6 is on revaluation, but before that, number 5 is on provision. Now we go to number 6. 1st of January year 6, the freehold land, which is a non-depreciable asset, was revalued to 28 million. So if you look at the freehold land in the question, the carrying amount of the freehold land, if you can check here, it was 20. This one, 20 million. You know that depreciation is not provided for freehold land. So therefore, you will compare the cost, which is the carrying amount, with the fair value. So it was revalued to 28 million. So 28 million minus carrying amount 20 million, you have 8 million. So that is a surplus because fair value is greater than the carrying amount. The freehold land will be debited. That will increase your PPE. by how much? By 8,000. And you will credit to the asset revaluation reserve freehold land, where the effects would be two. One is in the other comprehensive income in the SOPL. You need to go and add the freehold land to the other comprehensive income, and you need to also include that surplus on revaluation under your asset revaluation reserve under the statement of changes in equity. So that will be shown in our statement of changes in equity. Our focus is to do the adjusting journal entries. These are the depreciation information, number 7. But before that, you have the building. Building was also revalued. The cost of the building was 5 million. Yeah, the building that was being revalued is 5 million. And it was revalued to 4.2. So what you need to do is, you need to find out what are the fair value. Yes, given 4.2 million. And the next thing is that you need to find out what is the carrying amount. The carrying amount here is cost, the 5 million, where you can get the cost here in the trial balance for the building, this 5 million here, this one, and minus the accumulated depreciation of the building, 1 million, right? This 1 million. That will give you the carrying amount to be 4 million. So if you compare 4.2 with the 4 million carrying amount, there is a 200,000 difference. And this is another revaluation surplus that will be treated similarly to number 6 that relates to freehold land. So it's the same, only that is relating to a different types of PPE building. So remember, building will have to be have to be depreciated as well. Now we go to number 7. And number 7 is on depreciation. So you are informed here that the building has 50 years straight line method. Plant and machinery was 5% on cost, which also means straight line method. For motor vehicle, 10 years straight line method. So they are all straight line method. Depreciation for building is treated as admin, which is also the same for plant and machinery. However, for the motor vehicle, that is treated under distribution costs, right? So this is what we're going to do for number 7. Number 7, first recognize the current year depreciation on building. So you can see that I've done the workings here, and the amount should be 111,000. And how do you get that? You need to go and add the amount that was reclassified, which is 300,000, divided by the 50 years, the estimated useful life. And this 300,000 is the item building that was an IP that was reclassified as a PPE. So that goes what you get for 6,000. Next one is the remaining building. Remaining building here, we are referring to the fair value, where which one? This fair value, 4.2 million, divided by the remaining useful life. Remember, the building has been depreciated for 1,000. For 1,000, when it was depreciated for 1,000, and originally the estimated useful life was 50 years, if you see here, 50 years. So meaning that 1,000, if the building, the cost of the building without any changes, 5,000. So it means that this has been for already 10 years. So that is why you have the carrying amount of 5,000 minus 1 just now, 4,000. So therefore, the remaining useful life for this 1,000 depreciation, it was over 10 years period, right? So you take 4.2 million divided by 40 years. So you will get 105. That 105 will be added with the depreciation that you will continue to provide for the building that is now under PPE, the 300,000, and that is going to be 111. So that will be debited to the depreciation account and will be credited to the accumulated depreciation. That will be adjusted under admin cost and you need to also adjust under notes of the PPE in the accumulated depreciation section. Number 7.2. Okay. Number 7.2, I'm referring to plant and machinery. So for plant and machinery, what you need to do is you just need to take the depreciation. There were no changes the plant machinery was 3,000, the cost, right? So that will be multiplied with the 5%. So if you do that for 1 year, we have 150,000. That be depreciation, plant and machinery, credit accumulated depreciation, plant and machinery. That will be under admin cost and also will later be reflected in the notes to the PPE. Number 7.3 is on motor vehicles. Remember, the motor vehicles that you need to provide depreciation. If you look at the motor vehicles here, 500,000, 500,000. And the percentage for motor vehicle depreciation was 10 years. So 500,000. 10 years is also equivalent to 10% per year. Because by 10 years, if you depreciate each year 10%, in 10 years' time, it will come up to 100%. It means that it will be fully depreciated. So you can just take 500,000 divided by 10, or you can also take 500,000 times 10%. That will give you 50,000. That 50,000 there. Next one is the tax paid. Remember to include the plant and machinery under admin, include the motor vehicle under selling expenses, right? Okay, we'll go on to depreciation on motor vehicle will be treated as distribution expenses. So I'll adjust this here. Okay, distribution. Next, recognize the tax expense and tax payable. So what I do is I debit taxation 660,000. I credit the tax paid. Tax paid is this tax paid here that you have in the trial balance. This one, 500,000. It has a debit balance, so I close off by crediting it. And when I do that, I will get a tax payable of 160,000. That will be your current liabilities, or you can also disclose that as other payable, or you can put that as tax payable. The next item is auditor's fee. This item, yellow highlighter here, auditor's fee 100,000. This is in accrued expenses. Debit auditor's fee 100,000. Credit audit fees, accrued audit fees 100,000 should be under admin costs. You can also put that under other payables if you want to put them as under other payable, or you can put here as the accrued audit fees. You can put that as accrued audit. Okay. Next is the item that you have for final redeemable preference dividend. Earlier on, I mentioned to you that final dividend on redeemable preference shares, they are actually a finance cost, right? They are a finance cost, and therefore when it is a finance cost, it shouldn't be included in the statement of changes in equity. That dividend will be shown as part of finance cost. So debit redeemable preference dividend, this will be under finance costs. So it should be under finance costs, right? And credit final redeemable preference dividend 140,000, that is given to you. The next item is number 10. That was to recognize the bad debts being written off. So the customer owed the company 240,000 and was declared bankrupt. Unlikely that the amount will be recoverable, and therefore if that is the case, you need to write off that 240,000 as bad, and debit allowance for impairment of trade receivable with that 240,000 that should be adjusted in the current asset trade receivable, and you need to deduct that amount, and credit trade receivable 240,000, and that has to be also adjusted with the increase or decrease in the allowance for the year as a result of the having maintained the allowance for impairment. So here you can see that I've already done the calculation. This is what you have learned earlier in your FAR210. It should be 246,800. And if you can see, I've done and put some workings here. If you want to see the detail, it is available here. where I have also prepared the movement, yeah, the movement of allowance. How do you get that 246,800? First, you need to find out what is the balance at the beginning of the year, and that was given in the question. Okay, 9,500. Then you will write off the bad debts written off. Remember, bad debts written off just now was 240,000. So you write off, you go and debit to the movement or allowance for impairment. And you need to go and find out what are your new estimation for the allowance. So it is estimated at 0.5% as at 31st of December. So what you need to do is to find out what are the account receivable balances as at 31st of December. So 3.3 here is the one that is in the trial balance for the accounts receivable. Let me show you. Okay, you have to find the trade receivable 3.3, and you need to adjust with the transaction that happened during the year which has increased or decreased the trade receivable. Okay, one thing that has decreased the trade receivable is of course the bad debts, that 240,000. When bad debts 240,000 is where you credit your account receivable and debit the allowance much earlier. Another one is this 200,000 that you have done in your workings for your another one, yeah. It is somewhere at the bottom. Let me show you. I've been going too far upward. So it should be here. Okay, it's here. 200,000. So remember, you debit trade receivable when there was a bill and wholesale much earlier, adjustment number 21. So therefore, that would have been given some impact to the trade receivable balance here. So the trade receivable here is being added with 200,000. So 16,300 is as a result of these figures, which are 3.3 million minus 240,000 plus 200,000 times 0.5%. This 16,300 is the one that you will go and adjust under your account receivable. But the difference between the balance as at the end of the year, which is 9,500 plus 240,000, if you compare these two, these are the one that you have learned earlier, you would see that there was an increase in impairment loss of 246,800, and that has to be shown as increase in impairment loss allowance in your admin expenses. So that will be shown later, but this 16,300 will be deducted against the accounts receivable. Okay, that was for that adjustment. The last few items here is item number. Okay, item number 11. This is no adjustment for you to do. This is just a matter of capital commitment under MFRS 110 events after reporting period, because the transaction does not happen. It was just an information that you have made it available that the company has entered into a contract with a company called Fistula to purchase or land. And that was on 1st of February, right before the authorization date. So if you look at the authorization date is given in number 10, authorized for issue 30th of April. This happened on 1st of February. So therefore, this is events after reporting period, non-adjusting event. You need to provide notes. And when you provide notes to the account, right, that should be here, in which is requirement D3, capital commitment related to number 11. Okay, we will proceed with the preparation or the remaining answer, which will start with the statement of profit or loss, in our next video. I will see you then. I will see you when I will see you.